to go down to zero, or continues to go down, I should say, the indicator can't go below zero. Mathematically, it's not allowed to, so it just bounces around the bottom here. Now, what are some of the traditional buy signals for the stochastic indicator? There's primarily two. One is when K crosses back above D. In this chart, K is the black line and D is the slower blue line. Another traditional buy signal is when the indicator gets below the lower horizontal line and comes back up above it. But if you used either one of those traditional signals, well, here you'd be stopped out, here you'd be stopped out, here you'd be stopped out, here, okay, here the market finally goes up. So you'd have 3 losses before a win. So the reason those signals are bad, again, is just because it's a bounded indicator. So these crosses of the 2 lines or below the horizontal line moving up, meaningless. Again, when we come to a high, okay, we get a sell signal, but the market goes up, makes a higher high. Another sell signal. Again, the market goes up, breaks this high. You would have gotten stopped out 2 times, and that's the whole point. We don't want to get stopped out. We want to short the highest high. We want to buy the lowest low. So what does work is looking for a momentum shift. Remember, momentum can lead price because it starts to show weakness in the move. So even if you're trading price pattern, how would you know which is going to be the final high? Again, look at where your indicator tells you something different. This is what I call the mini divergence. Higher high on price. Now, what we're looking at is percent K, the black line, the faster line. We've got a lower high on percent K. That's your divergence. Momentum, stochastic indicator in this case, is leading price down. It goes down, makes a lower low before price does. And because it's way down here at this value, it's not way up here at the bounded edges of the indicator. So it has meaning down here at this value. So it shows us the weakening of this move up, and therefore we can have a high probability that's the final cycle high to short. And we wait for that. We wait for that. Now, I call this a mini divergence. A lot of people teach divergences, but most of the time what they're talking about is the difference between this high and this high over here, with the indicator going all the way down to the trough in between. Personally, I have not found those to be real consistent, and so I don't trade those. I call this a mini divergence because the 2 highs are very close together in time, and the whole indicator is in the top part of the range. The whole thing. It does not go down in between the 2 highs. So it's just a mini little momentum shift, and that's significant. Now, this is a scalp trade. Okay, this is in I offer a free 5-day video course that's totally free, just a service to the trading community, and I teach this trade. And I call it the rubber band trade. It's a reversion to the mean type trade. So this trade, the setup, since we've been in a downtrend for a long time, as I said, the longer we continue in a trend, the less likely I expect it to continue. I'm just looking for a quick scalp back to the reversion of the mean, which is the 50 MA. Now, let's look at the same chart, and where would we look to buy? Again, here's a traditional buy signal. Some people bought it. That bar makes a higher high than that bar, and then they get stopped out. We break the low of this low. So we wait for the mini divergence. Here it is. Lower low in price, little higher low on percent K. See that? So momentum shift, higher low in K, lower low in price, leads price. Now, where would we get in? Let's get super specific here. Okay, so once we get that mini divergence and percent K is angling up, I'm going to just put a buy stop in above the high of that little inside bar there. I'm going to make the market break the high of that little inside bar. As soon as it does, bam, I'm in. Literally just 1 penny above that high is all I need. Where's my stop go? A lot of you asked about stops. So to me, the principle of stops is the stop goes where you're wrong. In other words, you ask yourself, why did I take this trade? When the reason for me taking that trade is violated, then I want to be out. So I don't believe in using stops based on percentages or average true range or any of that stuff. Those are too wide for me. I don't like those wide stops. So for me, The reason I bought this is because, well, we're got back above the 50 MA. The 50 MA is flattened and started to go up. I'm looking to buy the first retrace in a new uptrend now, and I'm buying a cycle low. So what's the lowest low of the cycle? Well, that bar. So my stop goes literally 1 penny below the low of that bar. Entry is 1 penny above that bar. So my stop is, my risk is minuscule. Now, what's my reward? As I talked about, with trend trades, we are looking to catch the extended general direction of the market, a long-term move. So I consider an average trend to be 5 waves. And by the way, I used to be an Elliott wave trader a long time ago, and I love the principles of Elliott wave. They make sense. They're logical. The problem is I don't like the subjectivity of it. So I created my own ways of measuring waves objectively, so everybody gets the exact same wave count. So I'm looking for this. I'm looking for wave 1, 2, higher low, 3, higher high, 4, higher low, 5, higher high. So something like that would be my reward, and then that's my risk. So great risk-reward ratio. All right, so let's summarize here. We're just about done. All we're doing is we're waiting for the alignment of those 5 energies to put the odds on your side. And, you know, I went to a trading club. I was invited to speak to one of the largest trading clubs in the country, and I went out there, and I won't mention who it was, but the owner of the trading club, or the leader of the trading club, took me out to dinner, and his trading club, along with some of his other top people, friends, they were creating a trading methodology of their own. And they showed it to me, and it wasn't done yet, but so far it was over 200 pages long. And I thought, wow, that's quite a project. My trading plan is 1 sentence long. Okay, obviously I add to this, you know, money management and so forth, but it can all be pretty much summarized in this. Number 1, we're looking for trend. Are we looking to buy or sell? Is there even a trend? If there is, and then I've decided which direction I want to trade in, then the next question is it a strong trend or a weak trend? That's energy number 2, momentum. If it's a weak trend, I'll either not trade it or look to fade the trade, meaning I'll actually trade against the trend. If it's strong, then I'm looking to trade with the trend, and I move on to energy number 3. When do I want to get into that trend? And I use my second chance patterns on my cycle indicator to determine when to find the final low or the final high, so I get in and don't get stopped out right away. Because I'm buying and selling retraces, I go to energy number 4. I want to make sure I'm buying off support or shorting off resistance. And then finally, energy number 5, I look over the next higher time frame, and I've got to make sure that I'm trading in the direction of, not trend of the higher time frame, but of momentum and cycle of the higher time frame. And once I have that, then I'm good to go. So the method is very robust, very adaptable. I use the same 5 energy method on stocks, commodities, options, currencies, futures. I trade all of these. I started out as a stock trader because that's what my dad was. And then I went to futures and, well, commodities and futures, and then to currencies, and then to options, and now I trade all of them. I also trade the same 5 energy on all time frames. So whether I'm investing in my retirement accounts or doing swing trading or day trading, it's just a matter of using different time intervals. And sometimes people ask me, well, how can you have one method that works for all markets and time frames? Because aren't some methods designed just for certain markets or time frames? And yeah, some are. But the reason that this is so robust and adaptable is because, well, we're just using objective instruments to measure whatever energies are on the chart. So it's kind of like if I had a turtle and I wanted to know the direction or the trend that that turtle was crawling in. I would use an instrument called a compass, right? And I could say, okay, that turtle is crawling east. I could pick up that turtle and put down a totally different kind of animal, like a cheetah. And that cheetah can take off and go 70 miles an hour. Completely different kind of animal than that turtle. Do I need a different instrument to measure the trend of the cheetah? No, I still use a compass because it just adapts to whatever. Same thing here. Whatever time frame you're using, whatever market, we're just using objective instruments to tell you on that chart what are the energies. So it's a very simple method, very objective, and we're pretty much just counting to 5. So that's it. That's my presentation. I'll open it up for any questions. And oh, Kevin, maybe you can type in the link. We have offer for you guys today, and not selling you anything. I promised I wouldn't sell you anything, so this is totally free. I've got a free 5-day video course that I mentioned, and each day for 5 days you get another free video, zero obligation. And at the end of each video there's actually a quiz that you can get your answers right away to see if you followed it correctly or not. And it just teaches you some of the things that I do. When I told you that on that trend pattern that there was not a reverse head and shoulders there, I teach why that is not a reverse head and shoulders in this free video course. The rubber band trade I mentioned, I actually give away the rules and the details of that rubber band trade. It's one of my favorite trades. I still take that trade every single time it shows up because it's that reliable. Very, very high win-loss ratio. So yeah, Kevin, if you can give people a link as to where they go to get that, then that would be great. And while you're doing that, I will answer some questions here. Let's see. Got a lot of questions coming in. Oh my gosh, we got a lot of questions. Hoo-wee. Okay, I'm going to have to go up. Okay. Wow, there are so many here. I'm probably not going to be able to get to all of them, but I'll do the best I can. Is it being recorded? I don't know. Kevin, is this being recorded? Yeah, I'm pretty sure Real Traders, I think they do record their webinars for the future. I'm pretty sure, but Kevin can tell you that for
yes, we do,
sure.
Barry. They're being recorded.